Hello guys, it's the first tutorial for Accounting 101 presented by NoToAplus.com. I'm Kobe Huang and I'm going to explain to you today the balance sheet, aka the statement of financial position. So this is in your module 3. I know it can get quite confusing, especially for those people who haven't taken any accounting courses before. So I'm going to start with real simple stuff. So if you remember from the accounting equation, we have assets equals to liabilities plus equity. So asset is essentially what you own. What do you have, right? A liability is what you owe to other people. Um, Equity is real simple. What is left over, right? So if we think about asset, anything you own can be asset. So this can include, say, cash. So cash is the money that you have in your bank. Account receivable. Those are the money that your customer owe to you. So when you sell your goods and services on credits and supplies, that's your current assets. Inventory, those are the inventory stock that you have in your business, and buildings. These are the non-current asset of your business. There's only one example. There are a lot of them. And also liability. Let's say we have the really common one, account payable. Right, those are the money that you owe to your suppliers when you buy your supplies on credits. Notes payable, pretty much the same thing. The money you owe to other people and your suppliers, and then also income in advance. So that's the new one. What that really means is that you received the cash, but you haven't performed the task for the people who pay you the cash and loan the money you borrow from the bank. In equity, you have common shares or ordinary shares, and then also retained earnings. Those are the money the profit that you have that hasn't been distributed to your shareholders, and you decide to use them for future expansion of the business, right? So sometimes you might also see the equation asset minus liability equals to equity instead of asset equals to liabilities plus equity. So what that really means is that equity is what is left over. So think about that. You have a pie, and the pie is your asset. But according to the laws, the debtors are going to take the first bite of this of the pie, and second bite, or third bite for that matter. So in another word, until the liabilities are paid off, until the debtors are fed well by eating the pie. Right, until your liabilities are paid off completely, what is left over in that yellow area is your equity. Real simple. That is what's left over. I think that should be pretty intuitive for you to understand what equity is and what is liability. And when you add liabilities and equity together, that should equal the assets. That is your pie, right? I really like the pie idea. Alright, so right now we think about balance sheet. It's essentially a list of all these accounts. You just simply put all these accounts into the balance sheet as of a certain point of time. Now, I want to make it really important for you to understand as of is the date for balance sheet. Now, you might have noticed that as of is different from the income statement and cash flow statement, because on that they have, say, period ended or say year ended. So you might wonder why that is. Well, because value of assets, liabilities, and equity in the balance sheet are accumulated over time on a continuous basis, while the data for income statement is reset every period. So let me illustrate on that. Let me draw a time period. So in the first period you have $0, and then you have $5 and $10. The value doesn't really matter, but I just make it up for you to understand it. So $15. So what we essentially do right now is we take a snapshot as of that period, as of that period, as of that period. So as of that period, your assets, so your assets value of $15. As of that period is $10, and that period is $5, right? So as you can see, it's from $0 to $5, from $5 to $10. The value is accumulated over time, and then we just want to know at that point of time how much is the value, how much is it measured. So on the other hand, for income statement and cash flow, we're doing the same thing. We draw a timeline first from $0 to $5 to $21 to $24, etc. But in this case, it's different. Why is it different? Because we're not interested in that period of time. As of that period of time, we're interested in only one period. That is from $0 to $5. We want to know how much, say, profit you make in that period and how much profit you make in this period, right? Which is $21 minus $5. So we don't care about the $21. We don't care about the $5. We only care about what's in between, what is made, how much is made, how much is lost in that period. Now you notice that's a lot different from the balance sheet, which is accumulated over time. So you reset the data after, so you make $16 in your profit, and that in another period you start from zero, right? You start from the bottom, and now you make it $24, and then you set a period at zero again, which is different from balance sheet, which is accumulated. Right. So make things easier for you to understand, let's make up a balance sheet. So to make a balance sheet, the first thing you need to do is write a date, right? As we talked about it before. So let's say as of 29th of March 2017. So as we talked about before, income statement should be at the period ended 29th of March, or for the period for the year ended, right, etc., whatever you like to call it. So let's recall from the accounting equation, we start with assets, right? So let's just make up some stuff. Let's say we have cash account of $200. That was all the money that you have in your bank, right? There's a current assets, and then $200, and then let's say we have account receivable of $300. We have our inventory stock at $50. And our building, the next thing can be our non-current assets. That is our buildings. So notice that this is under your PPE section, and what that stands for is property, plant, and equipment, right? And that is, let's say that is worth $1,200, right? $1,200. That's your non-current assets, right? And the last thing that we can have is say supplies, right? We can have supplies, and that is worth say $20, right? So when you total them up, it should equals to $1,770, right? If I didn't do any stupid mistakes. So let's go back to the accounting equation. We know that asset equals to liabilities plus equity, and now we know that at the left hand side we have $1,770, right? And it's essentially what we want to do the same thing for the right hand side as well, right? It's essentially the same thing. So next step, we're gonna do liability, right? So let's say that we have accounts payable of $500. Those are the money that you owe, like I said, to your suppliers, right? Those are liabilities. That's why you have to pay in the future. And then notes payable of say $200. This is essentially the same thing. You owe money to people, except it's a bit longer period. And then long, how much you borrow from the bank. And then also, let's say income in advance. That's your customers. When a customer pay you the money, say $20, and then you haven't performed the task yet, you haven't earned the $20 yet. So that's your liabilities. And the total them up is $1,320, right? And the next thing, it's your equity, right? Equity. Let's say that we have issue ordinary shares that is worth let's say $400, and let's say that our return earnings is $50. So total of equity is $450, right? So one thing that you might notice that it is balanced, right? From the left top hand side um, of the equation, you can see that $1,770 of asset equals to your liabilities, that is $1,320 plus your equity $450. So that means that is the most important thing for balance sheet. When it's not balanced, you definitely did something wrong, right? So as you can see, instead of saying asset equals to liabilities plus equity, we are actually dividing up into different accounts, individual accounts, so the financial users, such as the shareholders, can see what is made up of the assets, right? What is made up of the assets, what is made up of the liabilities, and what is made up of the equity. So basically, we're just doing the same thing as accounting equation, except breaking them up for the shareholders to see what is going on, so they can make better financial decision for it. Right. So that's what balance sheet is about. And one last point that I want to make is the concept of book value and current fair value. So you might always encounter into a problem after you learn about a balance sheet. So you're wondering, when you sell your business, why is the value of the balance sheet is in fact different from the actual amount paid to purchase the business? So book value of a business is the value in the balance sheet. In that case, we talked about before is $1,770. So the values of your assets, right, is $1,750, or your liabilities and equity, total of your liability and equity. While a market value or a current fair value of a business is how much people are actually willing to pay for it to acquire a business. And that includes a lot of non-economic factors like, your location, your customer base, your goodwill, etc., etc. And let's say you can sell it for $2,500. As you can see, that is in fact different from $1,770, right? So the concept can be easily illustrated through one example. So say you bought a house that is worth $100,000. So you bought a house 10 years ago at $100,000. And after 10 years, which is right now, the present, right? The asset is still going to be recorded as $100,000 on your balance sheet, assuming there's no depreciation. But your house can be actually worth, say, $500,000. Alright, so in this case, as you can see, the $100,000 is your book value recorded on your balance sheet, and instead it's going to be stick on there forever, while the $500,000 is your current fair value in the market. So they are very, very unlikely to be the same, because that $100,000 is a historical cost, how much you purchased at the beginning, right? So yeah. This is all we're going to talk about for this video. If you have any other question or topic you would like us to cover next time, please comment below or contact us through www.notaplus.com. Thank you.